Right now, the markets are watching a pivot in how risk is priced and traded. Kalshi has doubled down on commodities, signaling a belief that real-world assets can be traded like bets and hedges. The timing matters because inflation anxieties, supply chain frictions, and weather shocks have made traditional futures less predictable for everyday investors. A dedicated hub for commodity contracts could unlock new liquidity, transparency, and choice, moving beyond traditional exchanges. As more traders seek simple, rule-based exposure, Kalshi's expansion touches miners, insurers, farmers, and even energy companies seeking clearer hedges in volatile seasons. The implications stretch from Wall Street to agribusiness. Kalshi is not listing a single metal or oil contract. Instead, it is broadening the scope of its platform to include a wider range of commodities traded as binary-style events and standard contracts, with a dedicated hub to organize them. In practical terms, this means more options for hedging or speculating on outcomes, like price moves, supply disruptions, or weather-related events. Traders can use these contracts to express views without owning the underlying asset, while issuers gain a transparent framework, standardized rules, and regulated oversight that differ from traditional over-the-counter bets. The result is faster access, clearer pricing signals, and more customizable risk profiles. To understand this move, recall Kalshi emerged from the world of event contracts, offering regulated bets on political outcomes and weather events. The commodity markets, meanwhile, evolved from open outcry pits to electronic platforms and complex risk management tools. Regulators have long teased greater asset class flexibility, while incumbents in futures and ETFs hold competing models. The new hub mirrors how other asset classes reorganized around centralized platforms, such as equities moving from specialist brokers to consolidated exchanges. History also includes cases where transparency and standardization unlocked unfamiliar participants, from farmers using price outcomes to hedge inputs to hedge funds seeking directional bets. Early liquidity signals are mixed but encouraging. Platforms like Kalshi reported growth in new open interest and tighter bid-ask spreads as traders test the concept. The broader reaction includes renewed attention from brokers, risk managers, and even legacy exchanges watching if faster settlement and lower friction can siphon volume from traditional futures. Banks are running risk models that incorporate event-driven outcomes, while funds compare cost structures and regulatory clarity. In practical terms, a dedicated commodity hub could push more participants into shorter duration contracts, potentially smoothing price discovery during supply shocks and crop seasons in volatile markets today. Manufacturers, energy firms, farmers, insurers, and asset managers stand to adapt. Producers hedging inputs will weigh new calibration methods for revenue protection. Retail traders gain access to regulated hedges that previously required custom OTC deals, lowering entry barriers. Alternative asset funds may reallocate toward commodity incident risk, while traditional long-only equity holders eye correlation shifts during inflation cycles. Exchanges and clearinghouses could experience volume diversification as more participants participate in non-traditional maturities. Financial media and analytics firms will recalibrate coverage to emphasize event-based risk, while lawmakers monitor consumer impact and market integrity. The tech sector and logistics chains could feel ripple effects. Global macro dynamics frame this expansion. Inflation trends, Fed policy expectations, and currency volatility shape appetite for event-driven instruments. Energy markets respond to geopolitics with sanctions relief, and OPEC output decisions injecting episodic price swings. Agricultural supply chains contend with climate risks and policy shifts, amplifying the appeal of hedging contracts that react to weather events. Kalshi's hub could accelerate cross-border participation, but regulatory harmonization remains uneven. Investors watch central bank rates, commodity inventories, and trade sentiment as signals that risk transfer will rely on trusted, auditable mechanics rather than opaque speculation. Geopolitical risk feeds demand for resilience and diversification. Smart money is testing the water with measured shifts. Some funds are layering event risk into diversified commodity theses, sourcing hedges that reduce tail risk and provide climate resilience. Banks study pricing models that incorporate incident-driven outcomes, while family offices and high-net-worth traders explore bespoke contracts within Kalshi's hub. Retail adoption hinges on education and perceived fairness, but a wave of educational content, demo accounts, and regulatory clarity is building trust. Some market makers are widening spreads and increasing inventory to capture early onboarding flow, signaling cautious optimism rather than wholesale migration from traditional venues for participants. Risks are non-trivial. If liquidity fails to materialize deeply, spreads could widen and contracts may misprice events, creating false hedges or speculative traps. Regulatory friction or a patchwork of rules across jurisdictions could slow cross-border flows, dampening participation. The hub structure may concentrate risk in a few market makers, raising systemic vulnerability during crashes or outages. Operational failures, data integrity issues, or misaligned incentive structures could undermine user trust. Finally, if underlying assets behave more like physical goods than predictable events, price discovery could become noisy and opaque for long periods. Regulators may tighten rules, dampening innovation and extending onboarding timelines. Retail investors should approach with education and defined risk limits. Start by using demo accounts to simulate Kalshi contracts in a risk-free environment. Then, set tight stop and take profit rules mirroring your budget. Favor diversified exposure across several commodities rather than a single bet, and compare contract types to understand how outcomes align with your view. Avoid leverage that magnifies losses, and monitor liquidity screens to ensure you can exit at known prices. Finally, use trusted sources, independent research, and community discussions to validate ideas before committing real capital in the new hub. Patience and discipline protect beginners from hype. Looking ahead, Kalshi's commodity hub could shift how institutions price risk and how households save for inflation. If liquidity grows and regulatory clarity improves, more real-world assets may move into regulated, transparent contracts, reducing blind spots in pricing. The potential is a broader food energy guidance, clearer hedges, and a more dynamic risk diet for portfolios. Yet builders must avoid over-promising efficiency or creating fragile claim on scarce data. The path rewards disciplined experimentation, patient capital, and rigorous risk management. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.